This week, we're talking to Rob Jansen, the CEO of Westcourt Capital, and we're talking about something that we haven't talked about before, which is advisor education and the role of continuing education in the financial services industry. We've talked a lot over the years about how we need to do more for consumer advocacy and more for investor education. What do you know about what advisors need to know when they give advice to their clients?
Make Better Wealth Decisions, a podcast that explores how financial advisors' blind spots can harm your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. In this podcast, we'll provide advice on how you can achieve better outcomes by maximizing investments and minimizing taxes. Let's put our thinking caps on as we consciously decide to get smarter about our money.
Co-Chief Executive Officer and Chief Investment Officer at Westcourt Capital, Robert Jansen's responsibilities include the selection and oversight of alternative approaches and to constructing diversified portfolios. Robert is registered as a portfolio manager and as an advising representative and dealing representative. He's a member of Westcourt's executive and investment committees. Robert, welcome.
Thank you. Good to be here, John. Thanks.
I thought it'd be good to do an episode about advisor education because I've done many, many episodes of Make Better Wealth Decisions. And oftentimes we're talking about how ordinary investors need to think about things, how they can make better decisions by thinking more purposefully. But one of the things that I suspect many ordinary investors don't think about is that financial advisors need to think about things too. And part of how they think about things is by doing their due diligence and getting engaged in advisor education. And that specifically goes to speaking to fulfilling their obligations for KYP, know your product.
Sure.
Advisors need to know what they're recommending before they recommend it. So it's all part of the advisor decision making. So that's where I wanted to go today because that's something that we've never done before in this podcast. So let's begin by asking this. What would you say are the main aspects that any advisor, or for that matter, any investor should look for when they're considering competing products?
It's a great question. And obviously we could spend half an hour just on that because it's the holy grail of trying to identify something that's additive to your portfolio. When you talk about education, I think it's something that's been eye-opening for us because where does Westcourt specialize? It's mostly in the alternative space. So it can be X stocks and bonds because those are so picked over. It's more private equity and private debt, real estate equity, hedge funds when appropriate. It could be real assets. It could be infrastructure and self-storage. We could talk a lot about those too. But when you're trying to identify a product, it has to have some very basic characteristics. As I said, it has to be additive to your portfolio. If not, there's no reason to be assessing it. So first and foremost, ballast. The only free lunch that we have in investing is diversification. It's something that's easily done, and yet I think is not focused on enough. People like to chase and look for returns and jump onto the bandwagons. We could talk about NVIDIA and how everybody seems to be jumping on a tech bandwagon these days. But to assess a product, it really does come down to, is it additive to the portfolio? Does it provide that balance? Or are you, on a risk-adjusted basis, are you trying to achieve a higher rate of return with the same level of volatility or the same level of return with lower volatility? And if it's not one of those two, because you can't necessarily have higher rates of return with lesser volatility, that's the just make money fund, which doesn't really exist. But I think it is important when looking at that. So it's not necessarily, again, the general assessment of looking at a stock, and we can get into the alternative world and what that takes with regards to KYP, know your product in the alternative space, because it is very different from the public markets. But it has to be something that is beneficial to the portfolio. And it can be within any of those different sub-asset classes within alternatives, as I said, private equity or private debt, real estate, real assets, et cetera.
Okay, so let's drill down to the obvious question. I understand that's what you're looking for, better risk-adjusted returns, and drilling down to move along the efficient frontier to get a better return with less risk, or the same return, a better return with the same risk, or the same return with lower risk. But if there are 3 or 4 products that are all offering that ballast, and they're all offering the same additive qualities, then the question becomes one of, okay, good. We've identified an asset class or a strategy or an outlook that we think that on the margin, if we put 5 or 10% of this kind of product into the portfolio, that the risk adjusted return would be better with something like that in than with it not in. How do you choose between 3 or 4 competing products that have a similar mandate?
See, it's a great question. And I think that the knee-jerk reaction, whether it be from the end investor or even maybe some advisors, would be, you must look at fees. And I think fees are important, but actually we would never reject necessarily a manager. If we're talking about an investment in a fund, we would never reject a manager if they have healthy fees, let's just say. It's actually, what is the value being created for the fees you're paying? Because you could have low fees and no return, or you could have high fees and excellent return, risk adjusted returns. But I think unto itself, I think people concentrate on fees too much. When we're assessing a manager or we're assessing an investment, it's important to remember that you are creating somewhat of a partnership. Tacitly, whether you like it or not, the moment you give a manager or an investment fund manager your first dollar, you're climbing into that relationship. And that relationship might last months, years, quarters. And so you better be comfortable with that. The counterparty, the person that you're working with across the table, is there to answer your questions, provide timely dissemination of information, be a good steward of capital, be responsible, etc. So we've seen a number of examples in our travels over the past 10 years where we thought a strategy was an excellent idea, but the investability didn't follow suit. So fees were one, the partnership is another, because it's more of a qualitative sometimes than quantitative. Do they pick up your call? Do they return the information and the responses to the questions that you've put forth? Then we look at things like tax. So what we're seeing now in Canada is so many of these major international firms, the big GPs, general partners of the world, let's say in private equity, the KKRs and the Carlyles and the Warburg Pincuses and the Silver Lake and all this sort of things, they're coming to Canada and they're offering different sorts of products. But most importantly, do they have Canadian taxation taken into consideration? So 10 years prior, we used to have the big managers come and they would say, oh, you can invest in this, but obviously there's no tax wherewithal. An American manager would be able to comment on Canadian tax. Now we're starting to see that change, which is so we're starting to see it shift one way or another. So that's a really important one. We've seen, again, excellent manager, excellent strategy. They haven't thought about tax whatsoever. Well, we're Canadian, we don't have a tax limit. So that could be kicking it out as well. Another one is alignment. You might have 3 excellent funds in your example. They all have similar fees. They all have taxation with a bow on it. And you might have one manager who has 99% of their investable net worth invested in the fund alongside you, and the other 2, nothing. So in our travels, we've seen examples where we've done 6 months of work on something. Excellent manager, excellent strategy. And then we're talking about a multi-billion-dollar fund, only to find out that the principals have a few $100,000 invested alongside you. So again, it would be exclusionary on some of these smaller, where again, the knee jerk is to look at the fees. If the fees are reasonable and it's an interesting strategy, we can go forth. And the last one I might add is just complexity. In your example, if you've got 3 that are doing similar things, if it's easy to understand, difficult to undertake, I would rather have a fund that I could explain to a client, because we are advisors, as you said, to be able to explain to a client, than the conceptual black box, esoteric, just make money, don't worry, we'll see how it goes fund. So taking all this into consideration, I think, competing products, you do start getting down into a pretty narrow funnel. And sometimes people ask us, as a firm, you're only trying to identify 1 or 2 excellent new investments per year. And we say yes, because that funnel is so wide at the top and it gets very narrow with all these criteria right at the bottom. So again, not just fees, there are other elements certainly that go into it for sure.
When you think about complexity, that once again has 2 elements. My view is that when you're giving advice to retail clients, they're more likely to take the advice if they can get an intuitive grasp of what the value proposition of the product is.
Yep.
And so they're more likely to stay the course and to understand if there's a rough quarter or whatever, oh, that's because of these unexpected rate hikes or whatever. And as a result, they'll say, okay, that's just part of running it out and being fine. And similarly, going back to the advisor obligation for KYP, for knowing your product, my view is that even though I believe that I and most advisors try their very best to do a good job of doing their due diligence, at some point when the complexity becomes such that, let me review that again. I want to make sure that I got that sort of thing where even the advisor has to double check his or her notes to make sure they're understanding what it is they're recommending. That to me is a bit of a red flag because there's just too much going on that if even the advisor doesn't have a good, really solid, at least intuitive grasp of what's going on and why they actually hold that product, that could be a risk. Now, the other thing that I thought of that you did not mention, and I presume it's because you assume that there's a degree of homogeneity, is liquidity. But
Mhm.
let's say, because we're talking about alternative products, lots of alternative products have varying degrees of liquidity. Some are T plus 20, some are give us the sell order this month and you can get your money back next month. But sometimes it's next quarter and sometimes it's 6 months from now. And to your experience, what maybe I should ask about the overall portfolio role. How much of a portfolio would you say should be going into should be going into illiquid assets in order to maintain a suitable asset mix?
Okay, I think that you've hit on a number of points that are excellent. So let's talk about a little bit about advisor education and as you talked about almost the responsibility to clients,
Okay.
and then let's talk about liquidity because I think those two things are tied. I think the reason why there's ever been clouds on the horizon or difficulties in the space of alternatives is likely because, and I'm going to use a dirty word, advisors have missold something. You hear about that all the time. They've missold something because, to your point, they don't understand the product in its granular fashion. So they've got enough information to be dangerous, but not a perfect appreciation for what the pros and cons are. So first and foremost, yes, I think advisor education is extremely important. That's why it's going to continue. And I know we're going to talk about a little bit about that in the future on the interview. The other thing is that liquidity ties into that. What are we remunerated for in this industry? Good conversations, easy conversations, and difficult conversations. Meaning that markets don't always go up, investments don't always work out. Of course, to make returns, you must be taking some sort of risk. There's risk in every single thing that we do. And liquidity is a big one. Liquidity is a risk if it's not explained correctly. Liquidity unto itself is not a risk, right? Because again, if someone says, I have an indefinite time horizon, then they really meant it. That's not a risk. They've absolved themselves from that risk. I think it's an advisor leaning towards an element of here's the liquidity in good times, but they don't explain that here's the likely liquidity in bad times. So I think it's important whether with regards to advisor education that those types of conversations happen up front. So and I love the point that you're making. It doesn't mean that the investment is a poor investment. It means the way that it was explained was done
Precisely.
poorly, right?
Precisely.
In the end, I'm going to make this up. You used a perfect example and the concept of what is alternative investing in Canadian apartments, right? Canadian apartments. You could say to a client, do you understand apartments? Yes, I drive by them on the 401, 3-story walk-ups, red brick. Okay, this fund owns a lot of those apartments. There's a certain affinity, there's an understanding. I'm invested in apartments as opposed to something very esoteric and complicated. I'm making this up. If everybody ran for the exits and wanted to sell, of course, the underlying assets are apartments. They're going to take time to sell. So one, as an advisor, should be explaining in good times, they have hundreds of millions of dollars of liquidity. In my example, you can redeem, we can move on. And maybe in March of 2008, when there's immense stress in the financial world, that liquidity might be skewed. That doesn't mean, again, that it's a poor investment. It just means that liquidity might be skewed. The concept of a gate needs to be explained to an investor before they get in, so that in a worst case scenario, these types of things have been addressed right from the beginning. I think that is actually the crux of the majority of the difficulties in the alternative market in Canada. Not necessarily, there are bad products as well, but it's not necessarily that they're all bad products or all good products. It's the understanding first from the advisor and the continued education forever, right? No one's ever a master. And then the explanation to clients on a KYP and KYC and is it suitable? So no, I love the point that you're making. I believe strongly in that point, which is half of the reason why we do so much continuing education and advisor education.
It's funny because I should also point out, because we're perhaps giving a bit of a false impression just with this conversation, that it extends to prospectus products as well, that
Yeah.
they can be missold and that they could be misunderstood by the person giving the advice. And I'll give you an example. 15 or maybe even 20 years ago, a major ETF provider came out with, they were pioneering the idea of inverse ETFs, things that you
Yeah.
could buy that would go down when the market went up and up when the market went down. And these, because of the mechanism underlying the product, were reset daily. And as a result of that, regulators ended up taking the position that portfolio managers could not buy these things as a buy and hold. In fact, that they were only suitable for day traders. You can buy the product, but it's
Right.
because you have an opinion on what the market is going to do on that day. You can buy it at 9:31 as long as you're out before 4 o'clock. That's fine, but you got to buy it and sell it on the same day. Or I think maybe you could hold it overnight one night. But that was the sort of thing that a lot of people were buying and holding and not realizing that even if the market went sideways, the actual product would be down
Yeah.
because of the reconstitution overnight. And a lot of people didn't think of that, didn't understand that. And they certainly didn't explain it to their clients when they got pressed. When regulators started saying, "Why did you recommend this?" It became clear that many of the people offering the advice to buy this product themselves did not understand that was one of the risks associated with the product. So it's not just offering memorandum alternative products. It can actually be prospectus products that are more plain vanilla that a person could buy off the street without even working with an advisor if they were a DIY investor, for instance.
Definitely. And then, by
Yeah.
the way, I
So,
will answer the tail end of what your question was. What is an appropriate level for a client?
yeah.
I think it's, of course, the answer is it depends, right? How long is a piece of string? It depends on the client and their ability to either withstand or embrace that illiquidity and the size of their balance sheet. But let's just say an investor has $100. When we're working with a client, if they have $100 and we're solving for right at the top, let's say it's a stratification. At the top, it's highly liquid, instant liquidity, daily liquidity, probably for an enormous chunk of their portfolio, 20, 30, 40%. From there, if you're talking about, are they going to buy another home? Do they have any major expenditures? Is their child getting married? Or is there anybody going to university? All sorts of different sort of lifestyle elements that could require a major outlay of capital. No, at the very bottom of their portfolio, right? When they have $100 in my example, maybe from the 80th to the 100th dollar, through education, through talking to the client, and through maybe embracing a certain level of illiquidity and being remunerated for it, right? Because you're not going to tie up your money for more than any time, more than a day, if you weren't to be remunerated for it. That's the illiquidity premium, right? Why does private equity hopefully garner higher rates of return than public equity? If not, you would just buy public equity, is of course you should be remunerated for it. So it does come down to talking to the client and revisiting it as well. It's not just an initial meeting and saying we're building a portfolio. So it does change for everybody. Obviously, the larger the balance sheet, the larger the family, and some of our families have more than $100 million in investable assets. Of course, they have the luxury, and it's really the word to withstand or embrace, as I said, that illiquidity, because things like lifestyle needs for philanthropic giving, keeping up with inflation are already taken care of, right? There's big green check marks beside those boxes. So they can really embrace that illiquidity in a grander fashion for sure.
Okay. Those are the sorts of things that I think a lot of people have an intuitive grasp of, but until they hear people like you and I bantering about what we're thinking about all the time, every day, when we go through various possible products that we could be recommending, they might not fully appreciate the thought process that goes into if this A or B or C, and if so, to what extent, and why are we holding this, and how long are we prepared to hold it for, and so forth. Let's talk about auditing. When you look at all these things and the different products that a person might be buying, what subject matters are being covered when you audit, let's say, how an advisor is doing his or her work? Is it the industry? Is it the regulator? Is it the firm? Who's actually checking to make sure that advisors are on top of their game when they recommend products to their clients?
I think it's almost a collective, right? We have a responsibility to our clients as a portfolio manager in a fiduciary capacity. That's one that's well-rounded and well-defined as a legal basis of and acting in the best interest of our clients. But it is a collective, and it's unfortunate. First and foremost, when a client's looking for an advisor, they should be looking up if they are registered, right? Are they registered as a portfolio manager? And then there's an ecosystem to it. Because again, as an industry, we do have rules and regulations that are set forth that we must abide by. And for all the advisors that are listening to this, everybody understands that the compliance regime that we work within is extremely stringent and rigorous. Why? Because almost to the point of the question, to ensure that someone acting in a poor manner, maliciously outside of the rules and regulations, hopefully that they're caught and kicked out of the industry. Because again, what's the functioning of our industry? The general goal is capital formation, right? So that businesses can raise money and continue to thrive and grow through investment. That's the general premise of capital formation and the reason why the industry exists. Whether it be the Ontario Securities Commission or CRO or the big regulatory bodies that oversee us, in the end as well, I'm going to flip it. It's really unto the client to ensure that they know who they're dealing with and in what capacity in this industry for sure.
But it's also safe to say, I believe, that reputational risk is paramount in the industry. And as a result, it's a very highly regulated industry. There are very few industries anywhere, certainly in Canada, that are more thoroughly regulated than the financial advice industry because the risks are what they are and the stakes are what they are. And the harm that would be done if people lost confidence in the advice being given would be almost irreparable. And so it's important that the industry guard that very jealously and very rigorously. Let's talk about what Westcourt does. You've developed Westcourt Academy to enhance education in alternatives for financial advisors. That's, to my experience, relatively unique. And I think you're to be commended because advisor education is every bit as important as investor education. So why don't you tell me a little bit more about what you're doing at Westcourt with regard to helping advisors understand how things work?
Thank you. In our travels and in our years of building the firm over the past 15 years, and in us being a portfolio manager and managing money for some of Canada's largest families, we've been asked over the years for a number of things. One, is there an ability to invest in the things that we do? And two, is there an ability to learn a little bit more? These are usually industry participants, other advisors that are asking that type of question. We tried to kill two birds with one stone. One was the launching of WPP, the fund, and we might talk about that in a minute or so. But continuing education and advisor education has been somewhat of an eye-opener for us. And it's mostly, John, because we're so passionate about it. On the weekend, when we find an interesting slide or a fascinating graph or something else that has a comment regarding private equity or infrastructure or other, we usually saved all these elements, right? We saved all these elements. We built slides, whether it be presentations that we gave or speaking on a panel or giving a keynote or something. And it's like anything that grows. We might not have set forth to say Westcourt Academy right now has 7 approved CE credit presentations, and yet it does. It takes time to build it. We launched the first one a couple of years ago and recognized that there was about 60 or 70 advisors that signed up. And I would hope that it just is an interesting bridge to maybe education on a certain asset class, but that equally allows people to do a couple of things. One, they can use the slides that we've produced. Two, they can ask questions on those webinars. And three, it can maybe stimulate a conversation offline that then again comes back to the point that you made. That is, I owe it to my clients to ensure that I'm well educated within this realm. You guys have done 3,000 hours of work on something. Can you help me get down the board a little bit quicker? So it's something that we're going to continue with. As I said, we've got 6 or 7 of these approved credit modules. And I would love it if we get to 20 or 25 or beyond. And so I think it's going to continue for years to come for sure.
And just for the benefit of the people listening, CE is continuing education, and advisors have an obligation to put in a certain number of hours of continuing education every couple of years, and that's audited, and you have to show your work, and people, firms, product suppliers, industry associations provide certificates saying you've got an hour worth of continuing education for this thing. And you've got various things. You've got product knowledge, you've got industry knowledge, you've got ethics, and you've got to be able to have a certain percentage of a certain number of hours in each of the above in order to maintain your license. And that's a necessary precondition. Now, that's not just unique to financial advice. My wife is a lawyer. She has to do continuing education as well. You'll find in a lot of the professions, it's what's required because their skill set would atrophy if they didn't pay closer attention to things as they evolve over time. But I think it helps people remain current and remain effective. Okay, so we're running short of time, so I have to end with the way I always end, and that is the podcast is called Make Better Wealth Decisions. If it was up to you, what would you do, Rob, to help? What would you recommend people do to help them make better wealth decisions?
I think it's almost cliche that I would say it comes down to education. I think people, and I nuanced it before, people are so quick to try and jump on a bandwagon or follow a crowd in investing that I don't know what percentage of people actually sit back, trust themselves, even if you're not an industry participant and this is all new to you. We have the same responsibility. I promise you that our educational arc as advisors and as portfolio managers is ever evolving and always continuing. And so if somebody has saved and it's their own money, don't they owe it to themselves to begin to learn? And that could be the most simplistic of things in reading a book or going on watching a webinar or starting to kick around on the internet and reading a little bit. It's probably the same way that a lot of us got into this industry when we were much younger and didn't have as much gray hair, because we found it fascinating, because every time we learned something, there was something new that went with it. So I would say education, and again, that's from the arc. It's from the person who has no idea about financial services and investing, all the way to advisors like you and me, who must continue, to your point, to continue to get better, because we cannot have a mastery or a perfection of any one of these elements within our industry and within our day-to-day. We're always continuing to evolve and trying to get better. Let's go with education for sure. I think it will help be the shield that people need when they feel like making a knee-jerk decision, and it will help them definitely over their lifetime. Be a sponge for education, be a sponge for knowledge, and things can only get better from there.
Thank you for your time today. It's been a real pleasure.
I appreciate it. Thanks, John.
John DeGooey is a portfolio manager with Design Securities in Toronto. The views expressed in this program are not to be construed as specific advice. It is recommended that you consult a qualified advisor before taking action. His books, The Professional Financial Advisor 4, Stand Up to the Financial Services Industry, and Bullshift are available through Amazon and in bookstores throughout Canada. You can reach John at 647-STAND-UP. That's 647-782-6387, or at jdegooey@designedsecurities.ca.